In the next 90 days, millions of Americans could see a significant portion of their home equity disappear as market conditions shift. For the last 3 years, the housing market felt invincible. Prices climbed month after month, and buying a home felt like a guaranteed win. But that momentum has quietly reversed. 3 specific warning signs have just flashed across the market data, pointing to a structural breakdown behind the scenes. We aren't necessarily looking at an exact repeat of 2008. The banking regulations are different today, but brushing off these early signals could be devastating to your portfolio. If you want to protect your savings and identify the few markets that are actually growing, you need to understand the exact domino effect playing out right now. The first domino is the cost of borrowing. Even with the Federal Reserve making minor rate cuts recently, the average 30-year mortgage is stubbornly stuck near 7%. Look at this chart comparing monthly costs. If you bought a standard $400,000 home in 2020, your mortgage was roughly $1,600 a month. Today, that exact same home at a 7% rate costs $2,500 a month. That is a $900 difference every single month, just for the loan itself. For the average family, that math is a brick wall. They are effectively locked out of the market. With normal buyers frozen on the sidelines, the structural weight of this market shifts entirely onto the people who already own property, which brings us to the second domino. Small-time landlords, the people running 2 to 5 rental properties, are quietly bleeding cash. The expenses of maintaining a property have skyrocketed. In coastal states like Florida and California, insurance premiums have doubled, and property taxes are climbing right alongside them. Landlords usually pass those rising costs down to renters, but right now, rent growth has hit a ceiling. Tenants simply cannot afford to pay more. So, properties that reliably brought in cash a few years ago are suddenly operating at a monthly loss. When properties lose money, investors sell. We are watching small landlords and massive institutional funds hit their breaking point and list their properties at the same time, sending a wave of new supply onto the market. That wave creates our third domino. Over the last 12 months, housing inventory across the United States has increased by 30%. A sudden jump in homes for sale usually means sellers are trying to exit before conditions worsen. The last time we saw inventory spike this aggressively was the lead-up to the 2007 price correction, and we are already seeing the impact. In Austin, home prices have already dropped 10 to 15% from their recent peaks. Analysts are tracking the same downward trajectory in heavily overvalued markets across Florida and the broader Sunbelt. Record high supply colliding with a frozen buyer pool creates intense downward pressure on prices. The old assumption that real estate always goes up in the short term is being tested. But real estate is extremely local. The market isn't reacting the same way everywhere. Smart money is simply pivoting away from the major, overpriced cities. Investors are actively targeting secondary markets where entry prices are still reasonable and housing inventory remains relatively tight. Places like Columbus, Huntsville, and Boise are emerging as alternatives. Their populations are growing, and the fundamental math of buying and renting still works. By relocating their capital to these growing regions and leveraging short-term rental models in high-demand pockets, investors are bypassing the specific risks currently impacting primary markets. The single most powerful strategy for the next 18 months, however, requires no real estate at all. It is aggressively holding cash. Look at the history of housing corrections. Significant fortunes are built by people who have liquid capital ready to buy quality properties at a discount when others are forced to sell. Having even a modest cash reserve right now changes your position. Patience is no longer passive. It becomes a strategic advantage. If you own a home and don't need to move, avoid the urge to sell into a falling market. But if you plan to buy, get your financing pre-approved today and build your cash reserves. The market is not going to change overnight, but the window to prepare for the best buying opportunity in a decade is closing fast.